Hey folks, let's chat about something intriguing today, abnormal returns. Before we dive in, make sure to hit that subscribe button, give us a thumbs up, and share our crypto glossary channel on YouTube to spread the knowledge. Now, let's unravel the mystery. So, what's the buzz about abnormal returns? Picture this, it's like when your investment returns decide to break free, either soaring sky high or taking an unexpected nosedive. It's all about the performance of your investments doing a little dance, stepping away from the normal and expected rate of return. But hang on, the impacts of this abnormal return gig are like a passing shower, temporary. It could be a result of funky fundamentals or even some not-so-honest business from the folks holding the cash. Now, let's clear up the dance floor and distinguish abnormal return from its cousins, alpha and excess returns. Alpha and excess returns are like the MVP moves of investment managers' performance. On the flip side, cumulative abnormal returns, CAR, is the grand total of all those abnormal returns, keeping an eye on the effects of external threats on stock prices. Wondering why abnormal returns matter? Well, when you're sizing up a portfolio's moves against the wider market or a benchmark index, abnormal return is your go-to dance partner. It's like the GPS guiding you through the risk adjustment expertise of a portfolio manager, letting you know if investors are getting compensated for the risk they're taking. And hey, remember, abnormal return is not a one-size-fits-all negative return. It can swing both ways, positive and negative. Now, let's talk about abnormal returns as your trusty evaluation metric. With abnormal returns, you can figure out if your investments are giving you a high five for the risk you're putting on the table. The math? Simple. Subtract actual returns from anticipated returns, and voila. If a mutual fund was expecting 12% but rocks a 26% return, that's a 14% abnormal return party. But, if it falls short with a 3% return, brace yourself for a negative 9% abnormal return. Shifting gears, let's chat about the Capital Asset Pricing Model, or CAPM. This model is your roadmap for calculating the expected rate of return for a portfolio or investment. It's like the guidebook describing the connection between risk and expected return. And here's a cool move, subtract the expected yield from the realized return rate, and you've got yourself some abnormal income based on securities or portfolio performance. Now, on to cumulative abnormal return, CAR. Picture this as the ultimate highlight reel, the aggregate of abnormal returns over a specific time period. It's like binge-watching your favorite show but for investment performances. Let's wrap up with a real-life example of abnormal returns hitting the dance floor. Remember when Tesla's, Nasdaq, TSLA, stock took a hiatus from trading in 2018? CEO Elon Musk's tweet about going private at $420 per share threw the stock into a wild dance. And then, in February 2020, Spotify's, Nasdaq, Spot, stock did a little dip after revealing a larger-than-expected loss. So, there you have it, abnormal returns explained in a way that's as natural as your favorite dance move. If you enjoyed this breakdown, don't forget to subscribe, like, and share our crypto glossary channel on YouTube. Happy investing, and stay tuned for more insights.